Yeah, I mean, you got a great handover from US market, so psychologically that is really a big booster, so to speak. Manish Gunwani joins us, represents uh, Nippon AMC. Let's talk about markets, valuations, and what is the way forward for the mutual fund industry from here. Manish, fantastic to have you back. Thank you for joining us. Manish, when we spoke a few weeks ago, there was uncertainty, there was a lot of fog on the windscreen. Markets were not sure which way earnings and recovery would move. But given that earnings season this time has been not satisfactory, but more than satisfactory, and all the important corporates are using the word recovery rather freely, do you think we are in for some more good days, or do you think we have a trend in making for earnings now?
Well, definitely. I think more on the global side, the recovery has surprised positively rather than the domestic side. And both in terms of the economy and the market action, I think a lot of what we are seeing is global rather than local. So one is on the economy side, clearly China, Europe, and to a certain extent US. The recovery has been much better than what people were concerned with in, let's say, March. India, I think, has lagged a bit, clearly, because the lockdowns have gone on for longer. But now that you're seeing the roadmap in the developed countries, I guess people are quite positive that the Indian recovery will also come through. Globally also, there is a lot of optimism on the vaccine front. So part of the optimism, I think, is coming from that side. And finally, there's no question that globally the stimulus has been unprecedented, both monetary and fiscal. And the kind of liquidity, and I think for emerging markets, the biggest variable is the dollar trajectory. And we've seen the DXY depreciate about 5-7% in rather quick time. And that clearly helps flows to emerging markets. So all in all, you have a very, very benign environment globally. Domestic, as I said, to a certain extent, I think the activity levels are disappointed over what we were hoping for 3-4 months back. But the good part is, and this we've been talking about, is that the strong are getting stronger, and the stock market is effectively a listing of the strong players in the economy. And added to that is the raw material benefit. As you mentioned, the margin side is where most of the quarterly earnings surprise has come from. When the biggest raw material you import, oil, is soft, clearly that benefit has translated a lot into good margins. So all in all, I think versus 3 months back, both on liquidity, on economic activity levels, we seem to be in a better shape right now. The flip side is, of course, the valuations are no longer cheap.
So for markets to go higher, Manish, what would markets now like to focus on? Because we are no longer cheap. Distress valuation, well, they no longer exist. Good companies, which are the survivors of this COVID crisis, they are already priced to a premium. So how does one go about investing and making money in this market where the pockets to choose and buy good companies at a good price, the underlying good price, is not freely available?
True. So I think for the market to go up, then now we're kind of asking the economy to do better versus Jan 2018 rather than the March 2020 concerns we had. Again, it's useful to remember that while for 10 or 15 stocks in Nifty, which kind of held on in 19 and earlier part of 2020, since Jan 2018, a lot of stocks in the broader market are still down 40-50%. And if the economy were to go back to where we were, let's say in 2018 level, before the NBFC crisis, before the US-China trade war, before COVID, and if that were to happen, even in 2-3 years, you can clearly make 50 to 75% in a lot of those stocks. So I think it's easier for the broader market to perform, both from a fundamental perspective, and also if the liquidity sustains globally at such benign levels. It will also help the operating and financial leverage stocks to outperform the more healthy balance sheet kind of stocks. And you clearly find them more in the mid-cap space. So my take is that I would think that the headline Nifty or BSE under the large cap index should have limited upside from here. Even on FY22 earnings at the index level, you're probably trading somewhere around 20 times, which is rich by historical standards. Now, globally, all markets are trading at rich multiples. So from a relative perspective, maybe that is not so much of an issue. But yeah, I just feel more comfortable with a broader market at this point of time, rather than the narrow large cap index.
Are you tempted to look at cyclicals? Are you tempted to look at companies which will benefit because of financial leverage, that is interest rates coming down, and operating leverage if demand comes back? Because up until now, markets have been hiding in IT, pharma, consumer because of visibility and because of safety. Is that trade reversing, or do you think the trade has already reversed?
I think it's some part of it is reversing. I think if global liquidity conditions remain benign, I would think that from here on, if at all the market has to perform, there has to be a component of financial leverage working, because banks and NBFCs are such a big part of the index that unless they work from here, a lot of the sectors, as you mentioned, the IT, pharma, consumer staples, it's really difficult to argue for a big move from here, because this year IT and pharma, a lot of the stocks are up 50, 100%. FMCG has been doing well from 2017-18 onwards. So to that extent, but also what is happening is, for 2.5 years, stocks got punished for just being small. So you had a huge valuation differential, even in FMCG and IT. And I still see that valuation differential being there. So if you see recently, some FMCG stocks which were small and with some issue on management leverage perception, suddenly short of 50-70%. So you will see, I think, a lot of those kind of moves, because there's kind of a bit of unfair valuation gap between the large stock and the small stock. That trade, I think, will continue. I think, as I said, I do expect that if the dollar were to remain so weak and the flows to emerging markets continue to be strong, I think banks and NBFC stocks should start picking up from here.
What about on the back of the domestic recovery, Manish, particularly the urban recovery? What are the themes that you would be looking at in light of that, with an eye to revival, potential growth, multifold, a sharp bounce back?
So if you look at some of the stocks which got worst hit in March and are still probably down a lot, are anything related to travel and urban consumption, which is high street or malls. So you have segments like organized retail, multiplexes, hotels, airlines, etc. Which I think that is probably again a space where, from a 2-3 year perspective, good money can be made, because I guess it's a matter of time before things normalize. Now, the good part is the ask rate in those stocks is that even if the economy were to normalize in 2-3 years, you can still make good money in those stocks. So So as we get closer probably to some development on vaccine, or as people learn to live with the virus, as things open up, I would expect, along with financial leverage stocks, that this set, which is travel and shopping linked, that set again, if for a patient investor, see, obviously, there are two things here. One is that next 2-3 quarters are not going to be strong for these stocks. So if you see a market correction, you should be prepared for the fact that these stocks again fall back a bit. Secondly, even among the stocks here, you obviously want some balance sheet strength or the ability to raise capital, because the cash flows will be strained for maybe 4-5 quarters more. So if those conditions are fulfilled, I think there's good money to be made in this segment as well.
Interesting. I want to take what you said on being a patient investor, because I want to get a sense of to what extent perhaps the current optimism, the current outlook on a revival is really already priced in. So while perhaps the fear factor has receded, in terms of the kind of run-up we can see from here on, given where valuations are, do you see that as slightly limited, at least for a shorter-term investor?
Look, I think it's necessary to focus on normalized earnings, which is what I was saying, that probably for top 10, 15 of Nifty stocks, they did not see so much of impact of COVID on their financials, or the valuation multiples never compressed, even going back to 2018, right? Now, a lot of the stocks which have domestic economy linkage or financial leverage, what has happened is, yes, on price to earning, they will look expensive at this point of time, because next 3-4 quarters, as I said, for a lot of these companies is going to be tough. That's why I'm saying I think you have to focus on the fact that what is the stock building in terms of how many years it takes for the economy to come back and these stocks to report the kind of profits which they did in FY19 or FY20. Now, when you look at it from that perspective, see, I don't think you can look at it from a price to earning or price to book or EV to EBITDA kind of perspective, because there is no profit virtually for next 3-4 quarters in a lot of these companies. But at the same time, if you were to just ask yourself that what would be the profit of this company when the economy goes back to FY20 pre-COVID levels, and see if the stock is cheap on that metric, I think there is still some way to go for a lot of these stocks.
Sure. Manish, I understand that you're launching an NFO as well, which I believe is open and closes on 21st. Tell us a little bit more about it.
Yeah, so this is a multi-asset fund. What our feeling is that a lot of investors need to do proper asset allocation. And a lot of assets get ignored by investors, especially foreign equities, commodities, etc. So this fund has 4 big asset classes: domestic equities, foreign equities, commodities, and debt. And we have fixed proportion of these assets in line with what we think are the long-term returns of these asset classes. So domestic equity is still the biggest at 50%. 20% is foreign equities, 15% is commodities, and 15% is debt. I think that is a very healthy asset allocation for a wide portfolio of investors. And basically what we're focusing on is that we keep it at these levels so that over the long term, the benefit of having a diversified mix of these big asset classes accrues to the investor. So basically, we think it's a kind of core part of anyone's portfolio. You can obviously do a lot of tactical things with different funds, whether it's fully diversified equity fund, thematic fund, sectoral fund. But this is, we believe, one of those products which should be a long-term product in the portfolio, which takes care of your core asset allocation.
That's interesting. Gold clearly finding part of everyone's portfolio. Manish, what is the house call on gold? I mean, we all know that Warren Buffett as well has bought into a gold miner. But that aside, do you believe that gold allocation will have to be upped going forward? Or do you think best of returns when it comes to gold are behind us?
See, it's very tempting to say, oh, gold has done very well for last 2 years, and typically being contrarian with an asset class like gold has worked. But I think it's also necessary to see where we are in the cycle from a long-term viewpoint and the macro around it. So first of all, gold is not very different from the peak it reached a few years back. Second is, see, we're living in a time where we're seeing unprecedented action by central bankers, unprecedented action by governments in terms of the kind of fiscal deficits which are the highest since World War II. Now, there is perceived to be likelihood of two big extreme outcomes happening, that you could have extreme deflation or you could have extreme inflation, right? I mean, a lot of people say, in spite of all kinds of central bank action for last 10, 12 years, US bond yields have always gone down. We've always lived in a deflationary environment, and nothing's going to change in that. There are others who say that if you look at the kind of fiscal deficits, US 15% kind of fiscal deficit, the Fed balance sheet going berserk, this will finally lead to massive inflation. The point is that the good part is that gold works both ways, right? So it's a good, I think it's like a insurance. It may be costly insurance at this point of time if you see near-term price action. But I think it's very necessary insurance because a lot of macro parameters, as I said, are in extreme cases right now. And with these extreme cases, you never know how commodities will behave, how inflation will behave, how growth will behave globally. So from that perspective, I do think that, see, the point is, again, with this fund, what we're trying to say is don't try to time asset classes too much. Yes, you can have tactical allocations around a core, but that core needs to be diversified. That core needs to be stable. So I think if, let's say, you plan to have 5% or 10% of your overall net worth in gold, I don't think it's time to junk that and say, oh, I'll be zero in gold. I don't think that is warranted at all, in spite of the recent bull run in gold.
Manish, as a portfolio manager, are you tempted to look at good companies which have got busted because of not busted? I mean, where businesses are broken down because of the crisis, which is, let's say, a company like PVR, Indigo, Inox, or would you like to stay with the obvious themes like telecom, digital, IT, pharma?
So on a very aggregate basis, we are more positive on the first rather than the second. The second, again, I'm not totally negative on IT and pharma. I think there are spaces which are cheap. As I said, a lot of the smaller stocks in IT pharma are still interesting. But yes, I think the bigger money on a 2-3 year basis will be made with things which just normalize back. So whether it's airlines or commercial vehicles or multiplexes or retailing. Again, everyone may have a different segment to play within that because there is no doubt that it may take time for a lot of these stocks to report good earnings. And B, I think that's a bigger problem, that if the consumer behavior has changed materially, then clearly you need to be careful about what stocks you're buying, because if the consumer behavior has changed and you're in the third or fourth rail in the industry, I think you're taking too much risk because at least even if demand collapses, the leader generally will do reasonably okay. So at least I think you have to be in the leader if you feel that consumer behavior has changed. But having said that, as I said, a lot of these if you keep these nuances aside, on an aggregate basis, I do think that the first lot is more interesting than the second lot.
Okay, so Manish, before we wrap, I'm asking you a very basic question, which is that for somebody who believes in long term and is a believer that cycles will be at play, tomorrow will be better than today, and tomorrow and day after will be better than tomorrow, how can one really get rich by investing in this decade? What could be that outsized theme, idea, or a clan where you should have disproportionate amount of capital allocation?
That's a very tricky question. I think that clearly if you ask on a 10-year basis, the kind of stocks which will work are something which will ride the technology wave for sure, because it's very difficult to engineer top line growth with an offline model at this point of time. So yes, while these tech stocks and the digital oriented stocks are very expensive, they're done well, and they may go through a crash like 2000. But the point is that if you go back to that area, period, Google or some of these stronger names actually emerged through that crash. So yeah, I mean, clearly the big money from a 10-year basis, it's very difficult to make without some IPR or a network-centric business model. Unfortunately, in India, a lot of that action is happening in the private equity space, not in the listed space. But I'm sure we will get opportunities. The other way is, of course, I think some of these healthy secular growth industries like banking, general insurance, retailing, periods like this year hopefully give you some chance to get in. And a lot of these businesses also some of the good businesses or good managements in these sectors should grow 15, 20, 25%. But yeah, if you're looking to make, 10x to 100x, I think it will have to be a bit of a technology-oriented play.
Right, Manish, thank you so much for joining us. We'll leave it there for now. Good speaking with you on ET Now.